G'day guys, Tor here from Pro Stock Tips, and today I'd like to talk about Nova Minerals, which I believe represents amazing value at the current share price, which is around about 5.8 cents and a market capitalization of 100 million. Now, as you'll notice, this is about 75% exposure to its lithium holdings in Snow Lake Resources. So that's 75% of the value is attributable to its lithium assets, and 25% or less is attributable to its gold resource, which is that 9.6 million ounce resource. So you're getting 9.6 million plus ounces at a valuation of $25 million. So that's why I believe it's incredible value at these prices. If you look at the chart, it's fully retraced back to some 2020 levels. So very affordable here, very good valuation in my opinion. Now they've just released their feasibility study, which is where we saw quite a significant drop off. I believe it was something around the lines of 30% on the day. So it's down quite substantially after the release of the feasibility study, which was actually surprising given it was a positive feasibility study. There may be some reasons behind that. I can go into those a bit later, but I would like to focus on the upside potential and the reasons why I believe it was a positive feasibility study. So essentially, the number one, consideration is that this is not the final result. This is not the PFS. In fact, this is just the tip of the iceberg. Essentially, we're going to see much larger numbers, I believe, in the PFS. So much higher NPV figures for the project, and I'll get into that in a moment. But let's have a look at what we can see here in the feasibility study. So it has a net present value of 500 million Australian dollars thereabouts, 380 or so million dollars USD. Now this is what a key consideration I think is very positive. The strip ratio is 0.76 to 1. So this has an extremely low strip ratio, and that obviously helps result in an all-in sustaining cost of 1,120 US dollars per ounce. So that's obviously a low cost figure. These guys can produce gold at a low cost, which is especially important at these high oil prices, high inflationary environment where costs are skyrocketing. So it's very important to have this low all-in sustaining cost, and that is of course due to factors such as like the low strip ratio. So it's very economic to mine this deposit, and they've proven that. Now what's also incredible is that it's going to produce 200 kilo ounces in its first year. So that's quite impressive. Obviously, that's also due to the low strip ratio. You have to remove less overburden, that sort of thing. And the feasibility study goes for 15 years. So obviously, they can probably extend this way out to 50 years even. This is just the starting figure, the PFS. This is another reason why there's a lot of upside, because we're only taking in 15 years. Essentially, they're only using 30% of the inferred resource, which is 1.5 million ounces out of the 5 million ounces on their inferred resource. So essentially, once they complete drilling and they promote a lot of the material, a lot of the ore from the inferred resource into the indicated and measured, so then you would certainly be able to incorporate that into the PFS and certainly add a lot more years to the total production. Also, financing, this is something they mentioned in there that was a positive, that numerous financiers are showing interest in financing their project. So that's very critical, because obviously a company is pretty much worthless if they're not going to be able to get their project funded and developed. However, if these guys can line up some financing, and this is very early on in the process that they've initiated this potential financing of the project, which is very important in my opinion. So very good very good management, I believe they have, to be looking into getting finance and funding at such an early stage. I think that's very important because I want to see production as quickly as possible, so in the next few years. And we also, we know once they do start mining that they can produce gold quite rapidly in the first year or so. So that's very important considerations. Obviously, bringing that production forward improves the net present value. So we've seen a positive NPV figure, which is very good. And also, I'd like to point out, the sensitivity as well. They're using a $1,750 per ounce gold price. Gold prices are currently around about 2,000. And obviously they could potentially even go higher. They could go lower, but it's trending up at the moment. So I think that's very positive. And another core consideration that I like to note, and you can also watch the recent interview with the CEO, Christopher, and he does mention this, is that their RPM deposit. So they haven't even factored this into this scoping study. And essentially, once the PFS comes out, probably next year, you would see that they will incorporate this 1.5 million ounce resource, which potentially could go way higher when they drill it out this year, probably starting next month. That 1.5 million ounce resource at 2 grams per ton, so it's very high grade with that world-class intercept that they achieved. And essentially what they plan on doing, provided this deposit doesn't grow massive in scale, as we can see the geophysics there indicate that this could potentially be a very large deposit, in which case you might want to not even worry about Gorbel and go straight to the high grade resource if there's substantial scale there. Otherwise, anyway, what they're planning on doing is constructing a pipeline due to the difference in elevation between RPM, the high grade deposit, and Gorbel. There's a difference in elevation, so they could use a slurry pipeline and bring all that down, gravity flow. Obviously you don't want to truck it because that's higher fuel costs, but if they have a low cost pipeline to transport that slurry down from RPM to Gorbel, then they can start processing that high grade ore, which obviously is very valuable material, much higher value than what we're seeing here at Gorbel. However, once they incorporate that, obviously the figures here should blow up. We should see way higher present value. Also pointing out that their sensitivity analysis also shows that grade improvements have quite a significant impact, obviously in, say, the leaching process and that sort of thing. If you're using a higher grade material at that step, then you're going to use less reagents and all this sort of variables. So essentially, upgrading the ore is quite significant and can have a very rewarding financial result. And we could certainly see that once they incorporate RPM, we could certainly expect that the NPV value should increase substantially. Now, another really interesting consideration here is that valuation, that $25 million valuation attributable to a 9 million ounce resource. However, the CEO reckons there could be 60 million ounces out here, and it looks like that it could be the case with some very good prospects here. They've only just started drilling at RPM. That could grow substantially. They got geophysics showing that it could be much larger. You've got all these other prospects that they haven't even drilled yet, with high grade rock chips and trends and that sort of thing. So certainly the 60 million ounces could be quite plausible. Perhaps they can get that. And essentially, if you're talking about 60 million ounces, you're getting a whole Goldfield for the price of $25 million. This is like buying Kalgoorlie for $25 million. So it's or buying 1/3 of the Yilgarn Craton for $25 million. It's an insane valuation, I believe. and it certainly implies a lot of upside potential to the MVA share price.